Hello, everybody. Welcome to the channel members live stream. Not really a live video. Well, it's kind of a video. It'll be up afterwards, so people can definitely watch it. So, fantastic night to be here. You guys had some pretty good voting. And so tonight we are going to be talking about basically the differences between investing in Canada and investing in the US. So, we'll hit on a whole bunch of different things. Which is better? Should we even be touching the US? Are those withholding taxes just absolutely crazy? What's going on? We're going to handle all of that tonight, of course. And then any questions you guys have, you want to drop them in the chat. We'll hit up them as well. Definitely, this is one of these ones where I have no clue how many people are watching because YouTube doesn't report it on channel membership videos for whatever reason. So I won't know you guys are here until I start seeing you in the chat. So I do know that Vic is here. So apparently it is just me and Vic. So all right, Vic, how you doing, buddy? How you doing? Yeah, anyway, we are going to talk a little bit about that. We'll talk about anything that pops up on your mind. Today was a fun day in the market per se. It really was. It's kind of flat. I mean, we did finish in the green, but we didn't finish in the green by much. Definitely not by much. Now, you guys will have noticed I sent out a what am I going to say? I was going to say an email, but
I'm not sure I understand.
Okay, my watch wants to get in. My watch wants to get in on the action. I know yesterday I sent out a community post for you guys just to let you know that I have included our first US stock in the 0 to 100K challenge. So that's kind of exciting. I did say we were going to eventually add some American stocks. So we do have our first one in there. It is it's actually an ETF. It's just an ETF. Sorry, it's an AI ETF. I was just looking at Vic. Vic's going crazy here in the chats. Apparently, he's been here from the beginning of time. Another insane day. Mary's here. Hello, Mary. Good to see you. Roaring 20s. I tell it. There we go. Let's do a Zoom. If it's just us 8, I have no clue. Are you actually able to see how many? I look at my count here and it shows me a 0. Just 0. It always does that on the live streams for whatever. The channel member live streams. It always does that. Anyway, before we get into any business, a quick shout out to the channel members. You guys are absolutely awesome. You guys rock. So a huge thanks for all the support to the channel. It means a lot to me, and it's always good to be able to give something back. We got these every month. We also have, of course, you guys get to watch the videos early. Today's video, holy banana bread. I'm really surprised I got it out as early as I did, because I'll tell you, the day got off to a rough start. I got up, I got everything ready. I was ready to start filming, and my battery on the camera was zilch, 0. And I was like, how did that happen? How did that happen? Well, I think what happened is after the last time I used my camera, I had plugged it in so it would be nice and fully charged. But the kitten kind of half knocked the cable out. So when I plugged this cable in that wasn't plugged in correctly, it just drained everything. It completely, it's like it did an opposite of a charge. It pulled all the juice right out of the camera. So then I sat down and I filmed the video using my phone. That didn't work. It put me sideways and it cut off my head, and I was just like, no. So I waited for it to charge, and so I was about 3 hours behind by the time I got to editing this morning. But I got through it. Got through that, got through the short. Everything is fantastic. So that's all fine and dandy. So once again, so the tech stock I said I purchased, it's an AI ETF, because it's like, you know what? I'm really getting bullish on AI, and I thought it was a good exposure to have. It also has a very small dividend, so I'm not super worried about the withholding tax, because it's not going to be very much. It's, considering the dividend is like a really small, I think it's a semi-annual one actually. but it's like less than 1%. So not super worried. But we're going to talk a little bit about that tonight anyway. We'll talk about withholding taxes and the tax treaty, all of that fun stuff. All right. Yes, Mary is. And Vic, you're doing some dishes and trying to type. Oh boy. Well, hopefully you get an Apple phone. So if it falls into the drink, it's going to be good. My favorite lurker is here. Hello, Glenna. Good to see you. And just us ladies. There we go, Vic. And Artie, I don't know who Artie is, or is it, or do you mean to say party? It's a party in the house per se. All right. Let's just start a little bit. We'll get right into some of the information, then we'll jump around and see what is going on after we get there. Let's see. Oh, Muggsy in the Woods is asking, have you bought any Bitcoin? Not lately. I haven't really been buying Bitcoin per se, but I have been swinging Bitcoin. So I've been doing trades using the ETFs, making money that way. I do think I've got a small amount in Wealthsimple sitting there. Basically, anytime I get a one of the referrals, so somebody signs up for Wealthsimple using my code, I get like $25. I just dump that into that. So, and then I pull it out every so often. So why not? Why not? But yes, Bitcoin has had a pretty good move over the last couple of days for sure. All right. Oh, was it RTETF you bought? Let me give you the exact initials. I can't remember it off the top of my head, but it was one of the Global X ones. I can tell you that. It was AIQ. AIQ, the Global X FDS Artificial Intelligence ETF. So yeah, and it's already up 0.02%. So it's moving in the right direction. It doesn't have, like I said, it doesn't really have a really big dividend. But here, you know what? Let me show you this ETF. Just give me a second here. I got to pull up a screen. And we need right here. Okay, so AIQ. Let's bring this up. That's not the whiteboard, believe it or not. That's just a page not loading. Why is that page not loading? All right. That's weird. I'm just going to re-pull it up. It is right here. There we go. All right. AIQ. All right, so here we are, the Global X Futures Analytics. Actually, it's this one right here. This version here, Global X FDS. It's their artificial intelligence ETF, and we'll just look at the last year. So you can see in the last year, as AI has been ramping up, look at this. It has been doing fantastic. So, if I'd gotten in a year ago, it would have been at 26. Now that's in US. But here's the neat thing. I'll show you guys. Let's see here. All right. I probably have to refresh this. I'm going to bring this over here for you. All right. All right. We're going to log back in. And it's slowly coming up. All right. So we're going to go down to the US one. I gotta move 58 cents over to cover it. But I can choose, like, this is it comes naturally in the USD price, but when I'm entering it into the challenge, here's the beautiful part. I can just switch it over to Canadian dollar and it'll give me all of it in Canadian dollars. So I don't even have to think about conversion when I'm entering it into the challenge, which is really, really good. Now AIQ, as I said here, here's its basically 1.9 cents USD is its distribution every month, or not every month, sorry, every twice a year, I think. I'm pretty sure it is, well, actually we're back here. Let's take a look. Yeah, semi-annual. So not too concerned about the dividend on it. Now, if it had a high dividend, it's not something I would want to put in my TFSA. I would prefer in that case to put it into like the RRSP. So just something to keep in mind. All right, now I need to get back. I need to get this screen back because, pull this over, because you guys are on it. So I can't see anything if I don't have this screen back. There we go. All right, we'll move this over. All right. And Vic says, I am non-binary, so I go by Vic or Victoria. There you go. There you go. Or we could probably find a word somewhere in the middle of that. I don't know. We'll just leave it at that. All right. So we have talked a little bit about investing in the U.S. market. So one of the we'll go with the cons. Or the pros. Let's talk about the big reasons why you should invest in the U.S. market. The very first, obviously, is the diversification that is in the U.S. And you definitely get, let's see, one, they have a lot more sectors than what we have in Canada. So you can take your diversification to the next level. So it's definitely good that way. So in Canada, we have pretty much most of our diversification falls into energy, minerals, materials, energy, minerals, finance. We don't have a lot. And even when you get to the tech sector, so for example, here, we don't have a lot of companies. You look at the US, they've got oodles of tech. They've got everything from aerospace to you name it, they've got it. So you have a lot. It's a lot easier by using American stocks to get a very, very rich diversification. So that's absolutely a plus because, the better diversified, that reduces, of course, your overall risk. And if you are a very conservative investor and you don't like risk at all, then you're definitely doing good. Now, think about it this way too. If I invest in Canada in the tech sector, and then I invest in the US in the tech sector, even though they're both tech, they come from two different economies. So that in itself gives you a little bit of extra diversification, even amongst the same sector, because you're looking at different markets. So that's just, to me, is just a huge thing. Now, of course, the next, and that takes us into huge. Well, the US market, it's the biggest market in the world. We're talking massive. So, compared to the Canadian market's probably about the same size as the Australian market. But we're not even close. So like this market completely dwarfs us. So that's definitely kind of a big factor that you want to put in. And you look at some of their giants, like their global giants, things like things like Apple, Microsoft, Nvidia. I mean, they've got the big stocks. They've got the giants, and to me, that's really, really important because what it does open up for us is a lot of potential for some really good returns in the US. That's one of the biggest drawing points, right? As investors, we're looking for higher returns, and that's what we can absolutely get into with the US. So when you look historically, the US market has offered better returns than Canada. It's just the way it is. And that's because, well, it's driven by very strong economic fundamentals. There's a lot more money in the US than there is in Canada. Simple as that. So that's another good reason. Now, my favorite reason here is overall liquidity. So what do I mean by that? Well, I'm talking about actual trading volume. So when you're looking at a lot of stocks in the US, it's easy to move them because there is a lot more volume. Typical volumes in the US are massive compared to Canada. So with Canadian stocks, and I'm going to backtrack a tiny bit on that, because if you are just buying and sitting on them forever, they're usually not an issue. Or honestly, if they're some of our blue chip companies, not an issue. But when you look at some of our you start getting into smaller non-blue chip companies, sometimes volume can become an issue, especially if you're doing swing trading or day trading, things like that, that can just absolutely impact you. So it's one of those things you want to be very, very, very careful of with that market. So that's why a lot of times, um, a lot of swing traders or day traders, especially even more day traders, a lot of them will play the US market. They won't even touch the Canadian market because they want that volatility. They don't want to get into a situation where all of a sudden what should have been a successful trade turns into a loss because it took a little bit for that, for that asset or for that stock to sell. So it's kind of that interesting thing. Now, the other kind of interesting thing too is sometimes you can actually get gains on the US market because of not because of the stocks themselves, but because of the changing currencies. So if let's say if you're invested in the US market and the Canadian dollar weakens, well, that's a time where all of a sudden your US investment is worth more. So if especially if it's something you're thinking of taking profits from, if the the US dollar stays strong, Canadian dollar drops. Holy banana bread. You've just made profits because of the currency. So that's a kind of another little layer as well as that whole currency aspect of it. And that can provide a pretty big boost. So that's kind of one of the things. That's one of the reasons why, like when I am doing a lot of trading, I will often try to go with an unhedged to the Canadian dollar version of something because I don't want that to play a factor. I try to remove that factor. So, for example, when I was swinging BTCC.B, I was using that one because it was pegged to the US, and I didn't have to worry about what the Canadian dollar and what the US dollar were doing in relation to each other because it didn't actually impact it. So those are just a few of the pros of investing in the US market. Now, we'll talk a little bit about the cons, but also in regard to these pros, a lot of times you can sort of sit back and say, well, okay, well, I still have access to the Canadian market. I can invest in a CDR, and that's true. That is absolutely true. CDRs will give you access to the American market, but and here's the thing: some of these benefits don't actually come into that CDR. So one of them, a huge one, is that liquidity. Liquidity does not happen with the CDRs because you've got a much smaller group of people who are buying them. They're being offered, I think most of them are being offered by CIBC, but it's one of those things like I would not day trade a CDR. I might do a swing trade occasionally on one, but they're just not good for that because of that. But once again, if you're like a sit, if you're kind of like, I'm going to hold this forever. Let's say, for example, you got the CDR for NVIDIA and you're just sitting there saying, I've got no intention of selling it. Then you're fine. You're absolutely fine. You don't have to, you buy the CDR, you just let it grow. You kind of can forget about all of the other stuff that's going on. But at the same time, I mean, let's say the Canadian dollar does fall when you're holding a CDR. Technically, you're kind of losing money that way because that CDR is falling with the currency at the same time, even though, if you had been holding onto the US stock itself, it wouldn't have fallen because, the US dollar stayed pretty stable. So just one of those things to keep in mind. All right. Before we get to the cons, all right. So why did you choose this one? Couple of things. I was looking at different ones. One of the things I was looking at is the profile of what they had done for the last little while. And a lot of the AI ones that I initially looked at, they weren't actually following the tech market. I was looking at them like, what? Why are these falling? And that was something I didn't want. So I was looking for one that did a little bit more of a mirror of overall tech. And this is one of the ones that I liked the profile. I liked how it looked. Let's pull something up here. Whoops. We'll bring this up since we have this. I also do like Global X, but, so this one here it's actually looking at the sorry, the INDXX Artificial Intelligence and Big Data Index. And that's a good one. They're looking at, that's an index that tracks pretty much all of the bigger companies in involved in AI. So they've got like everybody from NVIDIA, Microsoft, Apple, they're all in there. And so far, from the way I've looked at their track record looked really good. So I didn't have any complaints. So that's kind of what it boiled down to. It was also price range too, because where the funds in this thing are more limited, because where I had set that budget, the 500 a month in addition to supers, it was, to me, it was one that was in a price range where I could buy a couple, like maybe one this month, another one next month, maybe a third one the following month. As I'm divvying up the cash, it's kind of one of the things, like when you put yourself on a sort of a budget like that, it's like, okay, well, then you have to make choices. But I did that on purpose, because with that challenge, I kind of want to simulated somebody who, that's all they really had. They didn't have that opportunity. And I look at it this way, that the supers that come in, the reason I'm letting those go into the challenge is that that's sort of like you take your average worker, they get some overtime. So every so often they get a little bit of extra money from this, that, or the other thing. That kind of sort of simulates that as well. So it's kind of cool, All right. Yeah. And liquidity makes a huge amount of, makes a huge difference, especially if you are looking to make faster trades. And I will also put in too, so many people when they're doing a trade, are not using limit orders. So I like using limit orders. Like when I'm looking on a red market day, and I come in and everything is tanking, and I'm like, okay, I've got some sales here. I'm probably not going to take the price that it's at right now. So let's say I was looking at a stock and it was at $20.20, and like that's a fantastic price, but it's a really red day. I might just put in like a limit order for like maybe instead of $20.20, I might try 20.15. Let's see if I can get just even the 5. And you might be thinking, oh well, it's just 5 cents, but depends on how many shares you're buying. And, it all adds up. Sorry, I can hear the kitten purring like crazy. She came in to join us at the hide. Always fun like that. Vic says, I have Horizon Big Data and Cloud ETFs, now Global X. Yes. Yeah, and it's kind of a similar type ETF. So that's not a bad one as well. Let's see. I think Jensen Huang says it's pronounced NVIDIA. Oh, there we go. Yeah. Did I say NVIDIA? I don't know what I said, but NVIDIA for sure. Yeah, it's definitely, and I'm really, really excited for NVIDIA because we're getting closer to their earnings. I think before we get to their earnings, we'll break that 1,000. And I probably, holy banana bread, I probably should take a look. Whoops. Oh, I already am small. I probably should take a look at that right now because, it'd be funny if we'd already had, but we haven't. They're sitting at 943. Oh, look, there's the earnings right there on Thursday of next week. So basically 1 week, we will have their earnings. This will be interesting. This will be interesting for sure. I might just put a swing in on that. But the problem is you're dealing with a large share price, so I have to find another way to put a swing in. That's one where I could even use, I could potentially use a CDR. But as I said, not a lot of liquidity on that. So I wouldn't put a big one in, but I might put a little bit in just to see what happens. It'd be kind of fun. All right. And we've got Enid in the house. Hello, Enid. Good to see you. And Enid always uses limit orders. Nice. What's your opinion on NYDF in an LIF account? All right. So NVDY, of course, being one of the high yield, one of those high yield NVIDIA ones. And heck, let's show you guys. I'm here. Why not? NVDY. It would help if I actually could spell it. Here we go. So this is that Yield Max one. So these, of course, they're synthetic covered calls. So they don't even own NVIDIA, which is the funny thing. But they are basically writing covered calls. And sometimes if these covered call goes wrong, they may have to buy NVIDIA to give it out. But traditionally, they don't actually own it. So let's take a look. Let's look at this here for the year. Like, look at this. They had this whole big thing, but they'll go back up again. It's kind of one of these interesting things. I'm not fully on board with the synthetic covered calls, only because they haven't been around enough. For me, it's hard to sort of get behind something where they don't even own the product. But now here's the thing. Let me show you guys this one. This is one of their newer ones. MSTY. All right, so this is their here we go. This is their MicroStrategy one. So this one's pretty new. It's like it started. When did it start? Right here on February. It had this giant peak, but then it's come down. But here's the thing. Look at this yield. 125.637%. That is absolutely bananas. That is bananas completely. Yeah, that's a huge yield. I just can't, even knowing how synthetic covered calls work, I can't see that being sustainable. I just don't understand how they're getting that much. Now, mind you, MicroStrategy, they have so much Bitcoin on their sheet that they're probably just as volatile as Bitcoin. They pretty much probably track Bitcoin to a large degree. But I have heard that sometimes MicroStrategy will actually do better than Bitcoin, but that's another story on its own. So I'm thinking they're writing a lot of covered calls like crazy, and they're really working that volatility. But what happens when they absolutely screw up and Bitcoin does something absolutely unexpected? And then MicroStrategy falls the same direction. So I don't know. I don't know about these. But here's the thing. So for me, as long as you're not paying withholding tax, and even if you are paying withholding tax, because this is a conversation I had with Vineet. So take a look at this here. So right here, this one's giving you $2.52 a share. So if you had that in, you got a couple of options. So let's say you had it in your TFSA, no issues. That withholding, there's issues. You lose that withholding tax 100%. It's gone. So 15% just gone, which means instead of $2.52, you're going to get a little over $2, probably around $2.15, I think. I don't have the calculator to do the math because the calculator is my phone, which is filming right now. But yeah, around $2.15. Now, if you put it in like a registered account, so your RRSP, that you don't lose that withholding tax. That withholding tax is because of the tax treaty. See, the tax treaty recognizes a RRSP as a registered account, whereas it does not recognize a TFSA. Now, I am not 100% sure about the LIF. I would have to look that up, Enid. Part of me thinks that it might recognize it, but I don't want to definitively say yes until I actually know. So I'd have to look up on the LIF. Okay. Kevin Nikaz says, whoops, let's pull this up here. All right, we'll minimize this here for a moment. If not using limit orders, I feel that Wealthsimple always seems to buy or sell at least or at a less than favorable price to me. Yes. You also have to sort of think as well. So what happens is, we'll come back over here again. So traditionally, when well, let's go to a new part of the board. Traditionally, let's get us a green. All right, so I'm just gonna drop. We're just gonna say this is a share price of some asset. It doesn't really matter what asset it is. All right, so what happens with Wealthsimple is they are buying their shares. They're buying a lot of shares. So they're holding, because that's why they can do things right away. Because, and all brokers do this, it's not just Wealthsimple. They buy a whole bunch of their shares, and kind of their buying strategy is, and we'll use a red for this. Their buying strategy is when, maybe they bought here at one point, and then, that's fine. And, whenever it comes down, don't start doing that again. Whenever it starts coming down, they try to buy, because they kind of will look, and they'll buy at the low points. They might even buy here. If they're low, they may buy a little bit higher, but they typically try to buy at the low points. So if you think about that, what ends up happening here is, let's go back here, and I'm just going to say, we're just going to create a purple. So let's just say their average price that they've bought is about here. So that's the average price that has been charged to Wealthsimple for an asset, for a stock. So you come along as a user, and you're going to buy, and we'll give you, we'll make you blue. So let's say you buy here. All right. Whoops. Come on. B. There. You bought here. Let's say you bought here. You bought here. You bought here. And you bought here. All right. So what ends up happening, and we'll use, let's go with orange for this. So from here, that there is all profit for Wealthsimple. So Wealthsimple made that profit. Here, they made a little bit less from you, but that's the profit they made. Here, they lost. They actually lost a tiny bit of money selling it to you. But here, they gained. And here, they gained the most. So they're happy, because when it's going up, they're very happy. And they're going to have people, like, if this starts to fall again, they're going to buy again. But that's kind of, and what that is, oh, I can't do that. Let me just go to freehand. That's typical spread. That's what they call that. Now it's a little bit different than the bid-ask spread, but that tends to be that spread. So there's how brokers make money, because they're always buying. So when things crash, they've got the money. So let's take that big crash during the pandemic. On March 2020, these brokers were absolutely loving it. They were buying everything. Like, they were buying everything because they were just filling up their coffers with all these stocks. Then all the prices went back up, and we went into a bit of a bull market right after that, after the 2020 crash. And what were they doing? They were selling. They were selling like crazy, making, fists over dollars type things, or dollars over fists, or however that expression goes. They're making a ton of money. That's what they were doing. So that's really, really, really cool. And that's how they do it. Now, another way that Wealthsimple might make some money too is there's another form of spread. It's kind of like the buy-ask spread. But let's say, for example, we'll come down here. So let's say, for example, the current price of we'll go with Canoe. So let's say the current price is listed at $14.01 for EIT. So $14.01 is the current price. So when you go into Wealthsimple, what it may be showing you is, here's what I found. No, stay out of this, Siri. I'm not asking you. So when you actually go into Wealthsimple, it may be listed at like 14.02. So, and what'll end up happening, or maybe 14.03. But what happens is, if you buy a whole bunch of these, or a whole bunch of people buy these, the actual price is 14.01. So they're making a penny. off of every single one of those. And sometimes it depends on the stock and what the spread is, but you will notice this. So when you set a limit order and you say, I'm only going to buy it at 1401, well, you're getting exactly what you expect. So you're not getting hit with any kind of extra little bit of a spread. Um, you know, it's kind of just that neat little thing. So you don't get any surprises when it comes to that. But you will see that. So the price may be 1401 and you'll see 1402. So sometimes if you just go, if you were to bring up, if you've got multiple windows, bring up maybe 3 or 4 different price sources and look at the price, you'll see some differences. You'll see this now on normal stocks. You won't see it as much, like maybe a penny here and there. But if you look at something like the price of Bitcoin and look at it across a few different few different exchanges type things, you'll see different prices. And that's because they're all making a little tiny bit. They're making a little bit of money. Like ShakePay, I think at one point I worked out that it was like, I can't remember how much it was. It was something like 1.5% or something silly like that was that little spread. And you can actually look that up. I'm pretty sure that it is available out there. So they do have that spread, just something to sort of think about why you sort of see these price differences and why using limit orders can sometimes be really, really good. So you're not getting surprised, which is kind of nice. All right. Whoops. Let's go close this here. Vic says my folks have a synthetic house, really owned by the bank. There we go. There we go. All right. You're welcome. Mary says, I've tried to buy stocks on WSI with limited and Wealth Simple with a limited order, and the stock hit the target order, wasn't filled, had to go to TD to fill the order. Okay. Or I don't know if you're saying on Wealthsimple or if you were looking to buy WSI. Sometimes you will put in an order. So you may put in a limit order. And if it never hits that price, it doesn't fill it. So yeah, that is the risk. So if, for example, and this is kind of how I will play it, is I will put in the limit order, but I usually also sort of in the back of my mind, it's in the back of my head. And I'm looking, and if the market all of a sudden starts to recover, I'll probably go in there, edit the buy order, so the limit order, so that way there it will trigger it. I will do that in situations like that. But there are some times where I do miss an order. I think I put in a limit order yesterday for DIV. I just wanted to pay 1 cent less than what it was at. It never hit it, but it did expire at the end of the day. So that's kind of one of those things that you kind of have to look at. Now, there are other orders as well that you can use, like a stop loss order, for example. Here's a great way for a stop loss order. There's this thing called a trailing stop order. So or a trailing limit order. It works in such a way that it always maintains a certain amount below, and plus it moves itself up. So if, for example, all right, we'll pull this back up here. So if you're looking at a stock, and let's say that's the stock there, and it's going up consistently. So let's say right about here, we'll give you a different color. We'll make you green. So right about here, you buy in. And then what you would do is you would set something called a limit stop order, or a trailing stop order. Now, this you don't have available on Wealthsimple. They do. I know they have it on Desjardins, but you can do it on Wealthsimple, or you can do it in any broker manually. So let's say, for example, this here is, we'll give you a price. We'll say this is 11. Since I have the line tool, we'll say it's 11.11. So if you set a trailing stop order at maybe 5 below, so the way that would work is, let's bring this up a little bit. So you would have it set so that if the price fell to 11, 5 below is 6. So if it fell to 11.06, oops, there's only one decimal, you would then sell. You would sell because that's going to stop you from losing. But okay, suppose, and we'll go with we'll go blue this time. So suppose when all of a sudden it's up here and it's at, we'll say 11, let's say it goes all the way up to 1125. Well, you know, at this point, the way a trailing would work is that you had a 5 difference there. So what you would have over here is it would sell. If it fell back down to 1120, it would sell. So it would work that way. So you have to, when you're doing a stop loss order, so like at Wealthsimple or even on National Bank, I would have to manually do it. So when I notice it's up at 1125, I would manually go in to edit this stop loss and change it from 1106 to 1120. So a trailing stop loss will pretty much do that for you. It'll automatically do it. You don't have to worry about it. But in this case, yeah, they would manually do it. You know, and once again, if, you know, let's say up here, it gets up to, all right. Give me a second here. I got to, whoops. I got to stop doing that. I'm going to erase those because I don't like them. There we go. Whoops. I'll erase you too. Who cares? All right. So if up here, we're now in text, it got to 1150. Well, fantastic. I'll readjust that and I will change it. Let's go to green. At this point, I'll have one in at 1145. All right. But now here's the one downside, and this can happen. And this is one of the reasons that you try to keep a little bit of a buffer. If this decides to fall at that point, if it falls all the way down to 1146, you're fine. But let's say it fell to 11, we'll go right there and then we'll go up. I'll go that way. So we'll say it fell down to 11. Whoa, don't do that, Apple. If it fell down to like 11, here we go. Sorry, I need a blue. All right, so it falls down here and we'll say it falls to 1140. So it fell to 1140 and then it went back up. So in this case here, this gets triggered. So you've sold it at 1145. Considering that you bought in at 1111, you've made a profit. So you're fantastic. But you've missed this one little opportunity unless you're nearby. If you're nearby and you can come back in and say, oh crap, it fell down, it triggered, it's starting to go back up again, you can set up a new one and continue to ride it up. But even if you miss it, chances are that's fine. You've made your profit. So you've basically made you've basically made 34 cents on every share of profit. So if you had 100 of those, or if you had 1,000 of those, holy banana bread, you've done well. So it's kind of that neat little thing that does happen when you do it. And it's kind of that whole management part. So normally what ends up happening, and this is why a trailing stop loss is really, really good. If you're in the morning and you see this is strong, you've got an asset going up, you can put the trailing stop loss on, and then maybe halfway through the day it gets triggered. But you've made profit while you're off at work or you're away from the computer, away from the computer for that day. So just something to keep in mind. All right, I'm going to pull me back up, have a glass of coffee here or a cup of coffee. Okay. I did want to talk about the cons of investing in the U.S. market as well. So the first one, and we kind of touched on this, are the withholding taxes. So a withholding tax, basically, it's 15%. The government will hold it back. So where you run into these withholding taxes are in a non-registered account, in a TFSA, or, and this is the tricky one, if you invest in a U.S. account and that U.S. account then buys, if you invest in a Canadian ETF and that Canadian ETF buys a bunch of American stuff, well, that 15% gets charged on all of the different American stuff to that company. So here's an example. You remember the CDRs we were talking about? So this is another small disadvantage to them. So if you have a CDR and something that has high dividends, Well, 15% of those dividends are not going back to CIBC. So when they give you your share of the dividends, you'll have lost that. They're going to pass that on to you. So that's kind of the downside to it. Now, where is the best place to hold dividend stocks in the US? So the worst place, of course, is your TFSA. Your best place is your RRSP. Your second best place is going to be your non-registered account. And the reason for that is, well, you can apply for a foreign tax credit when you do your taxes, because what the foreign tax credit designed to do is for you to not pay tax twice. So dividends, of course, are taxable when you have them in your regular account, but you've already paid those taxes to the IRS. So what happens is that foreign tax credit basically prevents you from paying taxes again when tax time comes. So in that sense, you're still paying taxes as though it was a Canadian dividend in your regular account, but in this case, you actually paid it to the IRS opposed to the CRA. So that's just kind of, and that works in both directions. So just to put that in clarity, so somebody, an American who's doing that with, who's investing in a Canadian dividend stock, they're going to get 15% withholding tax if it's outside of their Roth IRA. And actually, it's not their Roth IRA. They have their own RSP type account. I think the Roth RIA works in the same capacity as our TFSA, but I could be wrong on that. I haven't really studied a lot about the American accounts. I probably should. But yeah, it's kind of an interesting thing. All right. Ooh, I just saw this and I just want to touch on this very quickly. It's a shame Wealthsimple doesn't have an edit function for stop loss. At the moment, you have to cancel and then resubmit. Ooh, that's rough. Now on National Bank, I can edit a stop loss, and I can basically just keep editing it and moving it up as the price on the asset goes up. So yeah, holy cow. Definitely cool. So that's a whole thing with your tax with your withholding tax. So kind of the way I look at it is that, I mean, it's not, if I have a stock that doesn't have, like, has next to no dividends and I'm really in it for the growth, for example, this ETF, this AI ETF that I just personally added, that to me, I'm okay with that in the TFSA. I mean, the dividends as it is are mere pennies. So, they're taking such a small amount. I'm not concerned about it at all. Now, if I was going after, let's say I was into something like, well, some of those yield max. If I liked the yield max, I probably would. It would probably hurt a little bit more because they're going to get more money than than I would like 15%. So 15% of a much higher value is, well, a bigger value. So I would be a little bit more concerned. So those would be things I'd be like, well, maybe I'll put it into my RRSP. But you got to keep in mind too, even though it's you're not paying the withholding tax on the RRSP, you are still paying the tax though, because that entire dividend, not just the 15%, that entire dividend will get taxed when you pull it out of your RRSP. So that is something that people sometimes forget. They're like, okay, yeah, if I put it in my RRSP, I pay no taxes. No, you pay 100% taxes. You just pay no taxes now. So just something to keep in mind. That is something that does happen. But in this case, you're paying taxes to the CRA after retirement or whenever it is you're pulling out of that RRSP, opposed to giving 15% now to the IRS. So, and here's the other thing too. You also have, I guess this is another good point. If you're looking at holding it in your TFSA versus your personal account, in a sense, it's kind of like who's getting the money, right? If you're holding it your TFSA, that 15% is removed. It goes to the IRS. You can't get it back. Nothing you can do. If you're holding it in your personal account, that 15%, roughly 15%, is going to go, well, it does still go. It still goes to the IRS, but you then don't have to pay taxes on it. So, it's still going. It's still going away. So it's kind of that fun thing when it comes to the withholding tax. Nothing we can do about it, unfortunately. All right. Now, the other risk, of course, of holding US securities is, of course, with monetary. So monetary, like foreign exchange. So foreign exchange risks can play a factor. And we've already sort of touched on this as a positive, but when the markets work, or especially when the forex works in the opposite direction, it can also be a negative. So, for example, if we have a weak Canadian dollar, you're going to be paying more for your US securities. So that's kind of one of those things. Um, and it might even be worth it to be parking money into like a cash ETF and then waiting for the waiting for the Canadian dollar to maybe pick up a bit if we're on a little bit of a small tear before you buy your US, or maybe wait for the US dollar to fall. So sometimes you have to take that into consideration. Well, but some people don't. Some people don't care. Some people who are just sort of dollar costing into their American securities are like absolutely fine. So just one of those things. The other thing, and this is kind of a big thing, you do create more tax complexity when you're investing in American stocks. So for example, if you have more than $100,000 in American assets, you do have to claim those assets, even though you're not taking capital gains or anything from them. The government still wants to know about it, and there's a extra form you have to fill out because of that. So it can create a little bit more when it comes to your taxes. And if you have an accountant, they'll probably charge you a little bit extra to fill out that form. So it's just kind of that whole interesting thing when it comes to keeping track of your taxes. So you do complicate things a little bit more. The only other thing is sometimes with the US market, you have to sort of keep in mind a whole bunch of different things from US economics as well as politics. And you also have to be aware if there's any changes in trade policies, trade deals, things like that, because sometimes it can certainly impact things when you're going across countries. Now, I think from our perspective, though, being in Canada, we're pretty much exposed to what's going on in the US so much that I don't think it's usually that huge of an issue. So those are just kind of those complexities. So I think what it boils down to, um, I don't think you can ignore that market. Um, and it's not that you have to. It's not that you have to sort of buy US stocks directly. I mean, if you want to go the CDR route, if you want to just, play with ETFs that invest in American stocks, that's perfectly fine. So, it just boils down to how you want to do it. But I don't think you should ignore that market. It is the biggest market in the world. There's a lot of opportunity there. So I think it makes sense. I think it makes sense to have some exposure. Um, you know, I'm not saying give up on Canada and just only invest in US. Although, I mean, so from the sounds of it, our pension funds almost do that. So, and that almost says something, right? If our pension funds invest so heavily in US opposed to Canadian, it shows that is, that's a path to profit. So just something to keep in mind. All right, let's get back to the chat here. Vic says, Moo and Weeble Chinese, so I'm hesitant to use them. Yeah, absolutely. I know Moo keeps on reaching out to me to promote them, and I'm like, nope, not going to promote you. Muggsy says, what are your thoughts on TELUS? Do you think the dividend is sustainable moving forward, especially when the stock is down almost 9%? The thing about TELUS, and this is kind of the same thing with BCE as well, although TELUS, I think, is in a little worse shape, but they both have pretty big moats. So I know with BCE, and I was just recently did that deep dive on them, BCE's fine. They have deep pockets. They can certainly sustain that dividend for long. And I think TELUS is kind of in that similar boat. But TELUS does have the issue where TELUS International didn't help them out that well. So they have a lot of extra burdens on them. So it's hard to say whether they can sustain it. But here's the thing. Once it starts going back up, once we finally get some relief in that sector, that 9% will start coming back down because it's just a reflection on where their share price is. or sorry, not the 9, I guess it's not a 9% dividend, but I'm just saying their current yield is going to start coming back down, which will be good. So we'll have to see. We'll have to see. My cousin twice removed wants to know if Mr. Math is single. Well, there is a Mrs. Math out there. And a Math family. We just haven't really introduced them in the latest version. So, yeah, look forward. Look for that. Look for that in the future. Vic says, "What's the next MFC?" Manulife Financial. That's interesting. I don't know. I guess when it comes to calling stocks, somebody actually over in Blossom had replied to me about and said, "Oh my God, did you start calling Bird Construction? That might be your next HMM.A." But that's because they had a good. They went up about 10% yesterday on their earnings. So I said I had a good feeling about Bird, and I did add them because I have a good feeling about them. So definitely like that. But MFC, not sure who would be the next. I mean, maybe MFC can be the next MFC. We'll leave it at that. Let's see. 529 is USA Respect. Okay, let's see here. Vinit's in the house. Hello, Vinit. Good to see you. Enid says, "Is it true that if you have more than 400,000 in the RRSP and TFSA, you don't qualify for GIS guaranteed income supplement?" Ooh, that's a really good question, Enid. I don't know. I've never run into that, but let's let me try something here. All right, so I'm gonna throw this in Chat GPT and just see what they say. Let's see. If you have more than 400,000, I wish I could just copy and paste this. All right. Can you still get GIS? All right. We'll see what she says, but no matter what she says, I'm still going to look into that because I think that's a really good question. I've not run into that in any of the stuff I have read to date, so I don't know. I'm leaning towards no, but at the same time, this government can sometimes be a little stingy. So let me see here. Yeah, according to and you see ChatGPT is backing me up, saying it's all based on your income level. Yeah, exactly. So as long as you're not actually withdrawing stuff, it shouldn't impact your eligibility. But of course, if you have that much in there, eventually you're going to start withdrawing from it, and then it's going to impact things. So once, for example, that RRSP turns into an RRIF, then you're going to be impacted by it for sure. I'll still go back to the CRA site, Enid, and just do a double check on that. But I was pretty sure I had never heard of it before. I've never run into it in any of the research I've done. And ChatGPT is saying the exact same thing. So I'm thinking that it may not be true. Let's see. Yeah, I see Vic is saying no, it's all about how much comes out of the account. There we go. Are you certain? Yeah, it is pretty low. It is absolutely. There we go. Oh, the 529 is the US equivalent to is that to our RESP? Okay, fair enough. All right. Holy cow. This hour has gone by pretty darn fast. But if you guys got some last minute questions, throw them in. I'll answer them. I'm here. I'm not tired. Yeah, I'm a little tired, but that's just because, it's been like I said, all of that kerfuffle at the beginning of the day when it came to making that video sort of threw me out of whack for the day. But this helps. Coffee. Very good. Very, 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 very good. So yeah, I was pretty impressed. Actually, Vineet is the one who came up with this topic, so I thought that was pretty good. I always like, and keep in mind, so when I ask you guys for the topics for the live streams, there's no It doesn't matter. You guys can come up with anything you want. We'll do whatever. It doesn't really matter. The only ones that I sort of say try to keep it, in line with the channel per se, is when we do the channel members one. But even then, it's like if you want a tutorial on X or something like that, that's perfectly fine. I'm all open for that. All right. Oh, Anita's saying, thank you so much. Thanks so much. Be well. Yeah, absolutely. All right. Doesn't look like we have any more questions. So we'll sign off for this month, but we'll be back here next month. We'll do this all over again. And I am always looking at ways to try to improve the channel member experience. So if you got the ideas, feel free to throw them over to me on Discord or Facebook, or or even on a message. It just doesn't matter. I'm pretty approachable. Um, you know, we'll talk. We'll talk. Anyway, until then, everybody, I'm gonna bid you guys a good night. Have a fantastic night, everybody. We'll be back here. We'll do this again next month. It'll be fun. All right. I'll see you guys on the weekend on the live stream. Take care.